If you've looked at your portfolio this week, I'm guessing the floor probably feels a bit shaky. It's January 28, 2026, and honestly, the technicals look like a fault line.
Yeah, that's not an exaggeration at all. We're digging into a market intelligence brief that covers today and the upcoming February 3rd options expiry.
And the data is pretty clear.
It is practically screaming tug of war.
Tug of war feels a little mild. I mean, we all knew FIIs were selling, but the sheer volume is, well, it's staggering. 40,000 crore just this month.
It's a massive outflow, and typically, that kind of relentless selling pressure would just send the indices into a complete freefall.
But that's the thing. I'm looking at the chart right here, and the Nifty, it broke its 200-day moving average.
Right.
By all rights, shouldn't we be seeing a collapse?
That is where the DIIs step in. They didn't just buy, they executed a truly historic defense.
Historic.
They pushed in approximately 9,000 crore rupees.
In a single day.
In a single day.
Wow, 9,000 crore. That is really impressive, but can they actually sustain that? I mean, if foreign outflows keep hitting those kinds of numbers, that domestic wall has to crack eventually, right?
That is the big question. But for now, they've created what the source is calling a DII-led floor right at that 25,000 level.
So they're just refusing to let it drop below that key psychological zone.
Exactly. They are effectively absorbing the foreign shock.
Okay, so the floor is holding for now. But today, January 28th, we have earnings. We've got Maruti, Canara Bank, and L&T. So why is the source flagging L&T so heavily?
You should think of L&T's earnings today as a sort of leaked trailer for the budget on Sunday.
Ah, okay. Because of the infrastructure angle.
Right. If L&T's order book is bulging and their guidance is strong, the market will basically start pricing in a massive CapEx push before the finance minister even gets up to speak.
It sets the tone for the entire industrial sector.
Precisely.
Let's talk about the open. Gift Nifty is pointing to a gap up near 25,300. So does that mean we're in the clear for today?
Well, not quite. It's actually a bit trickier. We're opening right above a major intraday resistance zone, which is 25,250.
So the test isn't getting there.
No, the real test is staying there without sliding back into that 25,250 trap.
And if it slips back, that support just becomes resistance all over again.
Yeah.
Now, this volatility isn't going away, is it? We have this huge institutional clash, and now we're dropping a central budget right in the middle of it.
Which is why the February 3rd expiry is being called the Super Bowl of volatility.
Because the budget is on Sunday, February 1st.
Right, so Monday and then Tuesday expiry day, they're going to be incredibly active as the market reacts to the speech.
So what does the data say?
The derivatives data shows max pains sitting at 25,200. But looking at the levels, post-budget, that 25,300 mark is the real line in the sand. If we hold above that, the 25,400 calls start to come into play.
And what if the budget, disappoints?
If we slip below 24,900, the 24,800 puts will get very active. For Bank Nifty, it's sitting on a strong base at 58,000 to 58,300.
But the upside?
A move above 59,500 could trigger some really significant short covering.
I have to imagine the premiums are they're expensive right now.
They're sky high, and this is crucial. The source warns against buying naked options here. Because of all the budget hype, implied volatility is really inflated.
Which means even if you get the direction right, a volatility crash right after the speech could just wipe out your profit.
Exactly. The recommendation is to use spreads to cap that cost. It lets you participate in the move without getting, crushed by the premium drop.
Smart. Okay, so to sum up, focus on holding 25,250 today, watch L&T for a budget preview, and maybe use spreads for next week.
And, trust the levels, not just the raw emotion of the moment.
One final thought for you to chew on. We are seeing domestic funds hold the line against the world. So does this mark a permanent shift where DIIs now dictate the Indian market? Or is this just a temporary dam that's about to break under the pressure? Thanks for listening to this deep dive.